Anyone who believes in indefinite growth on a physically finite planet is either mad or an economist.
We don't want to focus politics on a notion that involves the rejection of principles around which a large majority of our fellow citizens organize their lives.
We are not as endlessly manipulable and as predictable as you would think.
Over the past decade, there were two big stories in the world. One has, I think, been covered quite extensively, which is the global financial crisis. But the second big story, I feel, has not been that well understood or covered, which is that it was an exceptional period for the developing economies. Never in the history of the world had so many countries risen in unison as they had done over the past decade. In the year 2007, there are about 180 odd economies that are covered by the IMF. Only 3 economies contracted. Never in history had we seen so many economies do so well, because typically in any year, about 20% of economies tend to contract, and only about 1/3 tend to grow at a rate of more than 5%. In 2007, as I mentioned, only 3 economies contracted, and more than half the economies in the world recorded a growth rate of more than 5%. So it was a very exceptional period, with 2007 representing the peak of the past decade or so. But this also led to many myths. It sort of made it look as if this growth was really easy, that emerging markets were all set to conquer the world, because of their size of some of these countries, and they were all set to converge with the richer developed nations. And that is something which I always had some trouble believing in, because the conventional wisdom is never quite right, and that's what the conventional wisdom had come to be. As an investor and a keen observer of global economic and political trends, if there's something which I've learned over the years, it is that the unexpected always happens, the inevitable never does. After this extraordinary decade, where every single emerging market did well, and this extraordinary period which led to a rising tide of global liquidity lifting all boats, many of these emerging markets had begun to believe that they were destined to just keep rising at this pace, and the West was definitely like in a period of decline. So that sort of set me thinking that, has this been the history of the world? Is this time different? Is something different going to happen this time which has never happened before? Because as I was mentioning earlier, there are about 180 economies in the world today tracked by the IMF. Only 35 are developed economies. Everyone else is an emerging market or a frontier market. And many of these characters have remained that way for years and years, which is that they have one big decade of big growth, and then they falter. So the history of economic development is literally examples of countries that have been trying to get to developed market status, but have been faltering along the way repeatedly. Because it's like a game of snakes and ladders, which is that you climb up a bit, you get bitten by a snake, you come back down, you start again. Or some get lucky, they find the right ladder and get up ahead. But overall, the message is that the line is never straight from bottom to the top. And yet the past decade, because of the extraordinary boom, which had been caused by 2 factors according to me. One, that there was a flood of easy liquidity in the world. There was, in terms of starting with 2003, when the US was trying to revive its economy, there was a flood of easy liquidity, which we know caused a housing bubble in the US, and also like in the European peripheral and southern countries, it led to a massive housing bubble. But what's not appreciated is that that liquidity also found its way into emerging markets in record amounts. And it lowered the cost of capital for emerging markets, and brought their interest rates down, and also sort of boosted their economies by a huge margin. And now, as that liquidity is not that easily available, these emerging markets are finding it tougher to grow or have access to cheap sources of finance. So a lot of the emerging markets over the past year have been slowing down and going back to that old normal, which is that the long-term history of economic growth in emerging markets has been about 5% a year. And the second thing was some sort of a catch-up, which is that the 1990s was a very bad period for emerging markets. And I think people tend to forget how bad it was, which is that we had this Mexican crisis in '94, the East Asian financial crisis in '97, the Russian crisis in '98, and of course the Argentine default in 2001. It was really a very grim period for emerging markets. So my point here is that we need to figure out which countries will fail and which ones will succeed. And we need to do it over a reasonable time frame. The thing which really irritates me is when people talk to me about how the world will be in 2030 or 2050. Because the old rule of forecasting used to be that you make as many forecasts as possible and you remind people when you're right. The new rule of forecasting to me has come to be that you make forecasts so long out in the future that neither you nor I will know whether we were right or wrong. I mean, who on earth's going to come back and ask us that in 2030 or 2050, this is what you said in 2012? So I think we all need to be reasonable about the period that we want to forecast. To me, most of us, whether it's a politician, a business person, as an investor, are gauged on a sort of 4 or 5 year cycle, 3 to 5 year, let's say, sort of cycle. That's what most people look at. Economists like to sort of use these things called the RER, inflation adjusted exchange rate, like to figure out whether a country is expensive or whether a country is cheap. But to me, it's like if you just look at the Four Seasons hotel room rates across the different countries, it can tell you the same thing. So like in countries such as Brazil and Russia, what I found was that the hotel room rates are really exorbitant. Like to stay in these countries at a high-end hotel, the equivalent of a Four Seasons, you got to pay up to $1,000 a night. On the other hand, if you stay in a Four Seasons, let's say in Thailand or Philippines or Indonesia, it costs about $200 to $300 a night. And that, I think, tells you something, which is that Brazil and Russia today have very expensive currencies, and they're very uncompetitive. And to be able to grow rapidly, you need a cheap and competitive exchange rate. Most successful economies that have emerged have had that. China, of course, we know a lot about over the last 30 years, but even the likes of Korea, Taiwan, Japan, at their sort of stages of economic development, always had a cheap currency. So I want to invest in countries, and I think the countries have a better chance of succeeding if they have a cheap and competitive exchange rate. That's what the Four Seasons Index tells you. Another index that I come up with is something called a Billionaires Index. Now, this was something that Forbes has created to celebrate wealth and to do this sort of competitive ranking as to who are the richest people in the world. And my point is that this list can contain more information than just about which billionaires are rich and which are just about making to the list. For example, if you take the case of Russia, Russia has the second highest number of billionaires in the world after the US. And there's something wrong with that, because Russia's economic size is not so big. Russia may have the second highest number of billionaires in the world, but if you look at the list of millionaires, Russia doesn't even feature in the top 15. So it's all wealth being created by a few people. And it's not being spread out well across the economy. There's very little genuine entrepreneurial talent out in the economy. And the other sort of point here is that you've got to see as to who are the new billionaires that are coming up on this list and from what industries they're coming up. Because the more new billionaires you have, the better it is. It shows that new wealth is being created rather than when you have too many holdovers from the past. And the other aspect is that when the billionaires come from sectors such as technology, manufacturing, or consumer, that's a good sign because it suggests there's some genuine entrepreneurial talent. On the other hand, if the billionaires are coming out of sectors such as mining, real estate, often that's going on because they're well connected to the government. And that's not a good sign for an economy. You need sort of sustained economic success to come through on the back of popular will, that the people need to sort of understand that there's equal opportunity out there and they can become billionaires, but that they can do so by genuine entrepreneurial talent rather than having good connections to the government or where a few people control far too much of the wealth. The key thing I want to leave you with in terms of what makes a breakout nation, one is expectations, as I said. That expectations are key. That India's growth rate, for example, slipped last year to just under 7%. Now, many people here will say, wow, that's pretty good. 7% is a fairly healthy growth rate. But here, expectations are key. A growth rate of less than 7% in India felt like a mini recession in India, some sort of a downturn. Business sentiment was hit quite a bit, and the stock market fell more than 30% in dollar terms, and the fiscal situation is getting out of hand at those type of growth rates. So expectations are key. And two is per capita income, that the poorer you are, the easier it is for you to grow rapidly, and the more you need to grow rapidly. So if India grows at a pace of, let's say, 4 to 5%, that's a major underachievement. Because its per capita income is only $1,500. On the other hand, if a country such as Korea grows at a rate of more than of like 4% at a per capita income level of $20,000, that's a big positive thing. And so therefore, I think even the US is not such a bad place, because expectations are so low in the US, and they have some competitive edges to them. One is the currency is extremely cheap. They still spend more than 1/3 of the global spend on R&D is done in the US. And the fact is that their wages are quite restrained, whereas wages in some of these other emerging markets have been rising quite a bit. But the key thing is expectations, that most people thought that the US economy would go the Japanese way after the 2008-2009 recession. Instead, the US economy has been growing at about 2.5% or so, which is not a bad rate, not enough to create too many jobs as they want, but not a bad rate, and it's beating expectations. But the key thing here is one about impermanence, which is that very few economic stories are able to sustain themselves for a long period of time. And you've got to be prepared to change your mind, because they're like tripping over something, or they're losing their will to reform. And that's what's been the history of economic development, that over the past 60, 70 years, I've seen that in any particular decade, only about 1/3 of economies are able to grow at a rate of more than 5%. The odds that those economies can continue to grow at an average annual pace of 5% or more for a second decade are about 1 in 4. The odds that they can do that for 3 decades are 1 in 10. Only 6 economies in the world were able to grow at a pace of 5% or more on an average annual basis for 4 decades. And only 2 made it for 5 decades in a row. So the odds get against you the longer you grow rapidly. And those 2, by the way, were Korea and Taiwan.
You know, economists often aren't really interested in politics. When you talk about expectation, that's very much a kind of political game.
Yeah.
It is a matter of political leadership to explain to people that they should be patient, and to explain to people that countries need to invest in the long term, not just spend in the short term. And arguably our politicians are getting less and less good at telling people that, and some people would argue that democracies are not very good for that kind of message. There's a whole kind of public choice theory, as you know, around that. Tell me how important you think politics is in your rules of the road.
The question which is often asked to me is that, is a democratic or an authoritarian regime more conducive for high growth? And you have people with very strong opinions on that, because China's success has led many people to believe that if you have a command and control economy, that works better. On the other hand, you got sort of enough ideologues out here who think that the only way that you succeed in the long term is by having a democratic setup. So what I did was that I looked at all the high growth cases over the past 3 decades of countries that grew at 5% or more in any particular decade. And there were 120 such examples. And then I tried to figure out as to which of these were democratic and which of these were authoritarian as I went about this. And it's remarkable. The answer is 50-50. That if you go through the thing and you see as to how many were democratic, how many were authoritarian, it's 50-50. So to me, the conclusion here was that the political regime does not matter as much. For every country like China, which succeeds as a command and control economy, there is a country like Vietnam that's trying to ape the Chinese way and ends up with 20% inflation and 5% growth. Because in a command and control economy, you have to get lucky, because you have no feedback mechanism. So you're either right or you're just wrong. And in a democracy, this, like you may get feedback, but you may get paralyzed by it. So I think that the key thing here is that what matters is the leadership. You don't have to be that focused when investing in that is it a democracy or an authoritarian regime. Or what you have to sort of get right is the political leadership really focused on economic growth or not?
I've read some data recently that says that, quite in opposite to what my expectations might be, countries, as they become more diverse, become more unified internally and more divergent between them, which is quite the reverse of what you'd expect through globalization and population movement. Now, your book describes both economic convergence in terms of supply chains and finance, but also strongly argues that the future will be a future of greater divergence. Help us understand this convergence-divergence dynamic.
You know, there are two sort of things, which I find that I've always said, that one, we are like in a more globalized world, and two, that the technological progress that we made currently is very significant, so the world's a different place than it used to be. Now my point is that globalization is a steady trend. This has been done in waves over decades and centuries. And I think that, yes, we are like in a more globalized world, but this is something which is a continuous trend that's been going on for a long period of time. And I think that in terms of what I try and say here is that some trends may become similar because of globalization, whether it's the use of technology and the way it is applied. But I don't see as to how that should change the way that the outcome for nations is different, which is that you'll have some which will use the globalization and technology to succeed, and you'll have some nations which will fail despite that. So I think that, you're right, that there is this whole push and pull between convergence and divergence. So I think that there may be convergence in information, in trends, but the outcome can still be very divergent depending what you do with that information.
At the point at which the accumulated economic thought leaders of the world have said, this is the model that works, it stops working.
Yeah.
So is that just inevitable? I made a program recently for Radio 4 about how well Germany is doing. So
Yeah.
we love Germany now. Does that mean that Germany is just about to disappear up itself?
Well, a decade ago, The Economist had a cover story which went the hopeless continent for Africa, because it had just gone through a terrible period of the 1990s. And then I said this because about 3 to 4 months ago, The Economist had a cover story on Africa on saying the great continent, the rising continent, because Africa just had a spectacular sort of growth period over the past decade. And similarly, they had a cover story back in 98 saying how the price of oil is about to go to $5 a barrel when it was at $10 a barrel. So I think that, yes, there is something to it, which is that once a trend is very well recognized and becomes popular, you need to start thinking the other way. I think that is just a fact of life. Once it's very well recognized, a trend, it's sort of getting tired because life is always evolving and something new is about to show up.